Robinhood just gave millions of amateur investors the power to let AI trade stocks for them automatically. No human oversight. No emotional decisions. Just algorithms making split-second buy and sell decisions with your money. Wall Street has used AI trading for decades, raking in billions, but here's what nobody's telling you: 80% of retail algorithmic traders lose money in their first year. Let's break down exactly what Robinhood announced and why it matters for your wallet. The company rolled out an AI-powered trading feature that analyzes market data, identifies patterns, and executes trades without you lifting a finger. Sounds like a dream, right? Set it and forget it. But there's a massive gap between how this technology works for Goldman Sachs versus how it works for you. First, the technology itself. Robinhood's AI uses machine learning models trained on historical market data. It spots trends, calculates probabilities, and makes predictions about stock movements. The system can process thousands of data points per second, something no human can do. It removes emotion from trading. No panic selling. No FOMO buying. Pure logic. But here's the critical distinction. Professional trading firms spend hundreds of millions building their AI systems. They employ teams of PhDs in mathematics and computer science. They have access to proprietary data feeds that cost six figures annually. Renaissance Technologies, one of the most successful AI hedge funds, has returned 66% annually for 3 decades using algorithmic trading. Their secret? A combination of massive computing power, exclusive data, and constant human oversight. Robinhood's AI is fundamentally different. It's a consumer product designed for mass adoption. That means simplified models, publicly available data, and significantly less customization. Think of it like comparing a Formula One race car to a street-legal sports car. Both are fast, but they're built for entirely different purposes. Let's talk about the real risks. Risk number 1, overfitting. This happens when AI learns patterns from historical data that don't actually predict future performance. The algorithm sees a pattern that worked in 2022 and assumes it'll work in 2025. Markets change. Economic conditions shift. What worked during a bull market fails spectacularly during a recession. In 2020, many AI trading systems failed catastrophically during the COVID crash because they'd never seen that pattern before. Risk number 2, flash crashes and cascading failures. When multiple AI systems react to the same signal simultaneously, it creates feedback loops. In 2010, the flash crash wiped out nearly $1 trillion in market value in minutes because algorithmic trading systems amplified a sell-off. Now imagine millions of retail investors running similar AI models. They all see the same pattern. They all sell at once. The crash becomes self-fulfilling. Risk number 3, lack of transparency. Most AI trading systems are black boxes. You don't know why the AI bought a particular stock. You don't understand its risk tolerance. You can't audit its decision-making process. You're essentially trusting a system you don't comprehend with money you can't afford to lose. But there are legitimate advantages. Speed matters in trading. By the time you read a headline and decide to trade, the opportunity is gone. AI executes in milliseconds. It also eliminates behavioral biases. Humans are terrible at cutting losses. We hold on to losing stocks too long hoping they'll recover. AI doesn't have an ego. It follows the strategy ruthlessly. AI can also monitor multiple positions simultaneously. While you're at work or sleeping, the system watches your portfolio. It can implement complex strategies like pairs trading or statistical arbitrage that most retail investors don't understand. For experienced traders with specific strategies, this automation has real value. So should you use it? Here's the honest answer. If you're a beginner investor, absolutely not. The data is clear. A 2023 study from the University of California analyzed 50,000 retail trading accounts using algorithmic systems. After fees and taxes, 78% underperformed a simple S&P 500 index fund. The average underperformance was 4.2% annually. That's not a small gap. Over 20 years, that difference costs you hundreds of thousands in retirement savings. For experienced traders, AI can be a useful tool, but only if you understand what you're doing. Use it to execute strategies you've already backtested. Monitor it constantly. Set strict risk limits. Never let it control more than a small portion of your portfolio. Professional traders using AI typically allocate 10 to 20% of capital to algorithmic strategies. They don't bet everything on automation. Here's what you should do instead. For 90% of investors, boring beats exciting every single time. Max out your 401k. Buy low-cost index funds. Rebalance annually. That strategy beats most professional fund managers, and it definitely beats most retail AI trading. Vanguard's research shows that simple buy-and-hold index investing outperforms 85% of active strategies over 15 years. If you're determined to use AI trading, start small. Allocate no more than 5% of your portfolio. Treat it as an experiment, not your retirement plan. Track performance rigorously. Compare it to passive benchmarks. Be honest about whether you're actually beating the market after accounting for fees and taxes. The uncomfortable truth? AI trading works brilliantly for institutions with resources, expertise, and infrastructure. For retail investors, it's usually an expensive way to underperform the market while feeling technologically sophisticated. The house always has an edge, and in AI trading, Robinhood is the house. If you found this breakdown valuable, here's your homework. Calculate what your portfolio would look like today if you'd simply bought and held an S&P 500 index fund versus whatever strategy you've actually been using. The number might surprise you. Drop a comment with whether you trust AI with your money or stick with boring index funds. And if you want more honest breakdowns of fintech trends without the hype, subscribe so you don't miss the next video where we're exposing the truth about high-yield savings accounts that promise 5% returns.